Full disclosure, guys, some of you are going to be pissed. What's up, guys? Welcome back. Every single day, somebody asks me about monthly paying dividend stocks. Every single day. So today, I want to break down a couple and crown one and say, who is the best dividend monthly paying stock right now? But before we start, guys, I am first and foremost a YouTube watcher, not a YouTube creator. Monday is usually a great day for videos. My boy JJ Buckner, feeling a little under the weather today, couldn't release a video. He always cracks a beer before his video, so I'm going to crack one here for JJ. JJ Buckner, this bud's for you. I hope you feel better, buddy. Get down in the comments, guys. Tell me why you think JJ Buckner's a freaking legend. Cheers, JJ. Feel better, bud. So I think 2 days ago on my channel, actually a day ago, I posted about today's video. Right now it's like 10:30 in the morning. I'll hopefully get this up around noon. Keep things nice and live. I asked the best monthly dividend stock on the market. All right, so that's what I was going to do. Leave your comments. Let's see exactly what people said. I've looked at it. I've actually missed a couple, but I'm going to talk about all the ones that people mentioned so that we can dive into it. So right off the bat, everyone has, oh, Brad, can you be different? Possibly. I don't know. We'll see in a second. I think I responded like, if everyone has it, what's wrong with it? I don't know. But then again, if everyone's jumping off the bridge, are you going to jump off a bridge? Once again, since every dividend investing YouTuber loves realty income, well, I'm not a YouTuber, guys. I'm a school teacher that likes to, get on here and talk about stocks and apparently have beers at 10 o'clock in the morning on a Monday. I'm a regular guy, but he listed a couple other ones that we'll talk about in this video as well, LTC, STAG, and amongst some others that I'll talk about. Paulina Pipeline, don't know too much about them, so they probably won't meet my best, but we'll see. Realty Income, another guess. I've been starting, so then posted a couple. Some people posted things that weren't monthly dividends, or Wells Fargo, okay. Another Realty Income. This was a first of Main Street Capital was definitely mentioned in there. Main Street Capital, an awesome dividend paying, monthly paying dividend stock. STAG or LTC, AGNC, Johnson & Johnson is not a dividend paying stock. Either is KO. I think Alberto is just playing because he knows I'm not a huge KO fan, but that's also a quarterly paying dividend stock. And STAG, and Jesse mentioned that warehouse realty over retail realty is what's popping right now. So those are definitely things that I want to talk about. First, I want to narrow down the list from all the things that were mentioned inside this thread right here. Things like LTC, PBA, and Main Street Capital. Kind of want to get rid of them. I want to go down. I think it's fair to assume that right now the top dogs for monthly paying dividend stocks is definitely STAG and Realty Income. We can see there's a little bit of animosity there against Realty Income and STAG, a little bit of maybe competitive nature, which is fine. I think that's great, especially in business. Competitive nature is good. The reason I want to get rid of LTC, PBA, and Main Street Capital is because I really want to I want to crown the best. And I'm not saying that these other companies aren't good. I want to talk about the best. And there's certain analytics, especially about them. I'm looking down. I wrote down some things. If you guys watch how I analyze stocks, I kind of get a little sketched out when dividend yields go above 7%. So it's kind of like a red flag for me. It doesn't mean it's bad. Just means it's a red flag for me. Kind of like, why are they giving away so much money to maybe draw attention to themselves, get more investors, things like that. Okay, that's fine. But like with Main Street Capital, at almost 8%, I'm like, they do have a great 5-year growth rate at like 4.31, but they're also young. They've grown for 4 years now, which we'll talk about in a second isn't a big deal. But I think the major problem for me with Main Street Capital is they're a lending company, right? They lend money out. They're not a bank, but they lend to small businesses. And I think although lending is going to be very important as we come out of this economic state, I don't know how much money people are actually going to be borrowing if people are going to be starting small businesses. So it's just a little up in the air for me right now. LTC has a low growth rate, 2.25. They have no years of growth, and they pay a pretty average 6.3 dividend. So their dividend is like, it's good. But as far as LTC as an overall company, are they better than STAG and Realty Income? I don't think we could say that. And the same goes for PBA as well. Probably Pipeline. I looked them up, 4 years growth, 7.75. Once again, that high sketchy dividend for me. And their growth rate at 2.85, a little lower than I'd like to see it. So getting rid of those aside, let's sit down and let's just talk about STAG and let's talk about Realty Income. So I'm going to stack these guys up side by side and look at a couple different metrics that are important to me, right? They're important to me. They may not be important to you, or you might have metrics that you think are important that I left out. But I just want to show you the things that are important to me when I'm picking dividend stocks, and then we'll let you decide which one you think is better, which is the best monthly paying dividend stock. So just quickly background about each one if you're just not sure about it. Let's look at Realty Income, just their main website. And you can see they've actually trademarked the phrase, the monthly dividend company. To me, that doesn't really sway me one way or the other. That's just a trendy catchphrase. But they do have a huge established long-term business, which is definitely good. Of course, they flash Coca-Cola right there, just mocking me right in my face. But I think the major criticism that they're getting right now, and we're going to talk about it, is definitely, the type of businesses and the type of buildings that they own. They have a much different, company strategy than STAG Industrial, and we'll see when I talk about STAG in a minute, but pretty much these are just companies that are in the retail space. Let's look at their top 20 tenants. And some of these top 20 tenants are really going to be affected by what's going on right now in the economy and moving forward. But a lot of these names I think can survive even an economic crash. I mean, every small town in America has a Dollar General, Walgreens, 7-Eleven is open 24/7. I go to 7-Eleven on a daily basis. Amen. And FedEx, things like this. But we get down like these two right here, LA Fitness and AMC Theaters. They're taking a hit now, and they're going to continue to take a hit. And we can see that with the combination of all, it's almost 5% of their revenue. We see another right below, another movie theater. So there's this couple of businesses here that are really going to be dependent on what happens in the economy. And STAG really doesn't have to worry about some of these because they're in the industrial space. That's what Jesse was saying when he says that, if we go more towards the industrial side as opposed to the retail side, STAG kind of has a little bit of advantage, which we'll talk about in 1 second. But these top 20 tenants hold about 50% of their total revenue. Now, STAG is a completely different company, okay? STAG Industrial, a real estate investment trust focused on the acquisition and operation of single tenant. So once again, these are both REITs, right? They're both real estate investment trusts, which is a little bit different than a company, especially when it comes to looking at some analytics. I'm definitely going to talk about payout ratio. That was something that somebody brought up. But we can see they're much smaller. And I really can't hold it against them, but if we're going to crown the best, it has to be something that we're definitely going to look at. Right now, they're in 38 states. They have a lot of room to grow. Realty Income is in all states, Puerto Rico, and they've even just moved into the UK. We're going to talk about, their market caps. We're going to talk about the number of buildings. But we can see, if we look at STAG, we see their properties are mostly these warehouse, okay? They are going to be factory style and warehouse. And we know moving forward that retail is going to go down. Amazon's looking for warehouses every single day. Even here in New York, they are purchasing warehouses to store items to ship out with this e-commerce line of business that's going on right now. And that's not going to slow down, in my opinion. So STAG building these warehouses, automotive, and other types of factories, they might have a slight edge moving forward over the retail space. So now let's dive into some numbers. Guys, I'm using Seeking Alpha. Every website's a little different depending on when they update. I'm just using Seeking Alpha right now. So right now we have Realty Income. Their share price is $58.81 and STAG Industrial is at $28.59. To be honest, right now with all these companies using fractional shares, I don't really tend to look at share price as much. I will take it into consideration when we talk about evaluations and, is it overvalued, undervalued? But right now the share price, they're close enough where it's not that big of a deal for me. So let's look at these side by side with a couple of different metrics. First, let's look at the dividend yield, right? They're dividend paying stocks. They both pay monthly. They both pay REITs. So let's just look at the dividend yield first and foremost. So right now with Realty Income, we see that they have a dividend yield of 4.8 and STAG has a dividend yield of 5.21. So right now, STAG's is higher. It is bigger than Realty Income. So we're going to give that one right to STAG. Right off the bat, better dividend yield right now. The next metric that I want to compare is dividend growth. How many years in a row consecutively have they been raising up their dividend? And we see that Realty Income, they're a dividend aristocrat. They're on the S&P 500 list, huge company. They've been raising their dividends for 26 years. STAG, 8 years. But when I compare the two, I'm going to put this as like a wash, a tie. Why? Because it's not like STAG has been around for as long as Realty Income. They went public in 2011. So, saying that they've only had 8 years and that puts them behind Realty Income, that's like saying that my grandma's better at picking presents because she's seen more. So I'm not really going to hold that 8 years against STAG. They went public in 2011, so pretty much they've been growing it since day one. But how I will use this metric to evaluate both is because they went public in 2011, they have never experienced an economic downturn, right? Since 2011 up, especially in real estate, everything's been on the up and up. Where Realty Income, they've gone through the 2008 financial crisis that we went through, and they survived through it, and they actually did really, really well. So although I'm not going to look at the growth over years, I'm definitely going to look at the fact that STAG has never been stressed. So if we look at like a stress test rating, they've never been stressed out. So as far as the ability to overcome stress, I'm going to have to give that to Realty Income. But then again, we can wash that out because I think it's true what Jesse said. As we move forward, I think that STAG Industrial has less risk in the next financial situation than Realty Income does. So for the future, like what could happen, I think with this industrial space in the warehouse, I'm going to have to give future potential to sustain through. I'm going to have to give that to STAG. Even though Realty Income survived the last one, I think we're in a different kind of crash than we were in 2008, and I have to give that advantage to STAG Industrial. Next is a metric that's really, really important to me, and that's the 5-year growth rate. We can see that STAG, their 5-year growth rate is 2.08, where Realty Income is 4.38, more than doubled. I don't think you could, just brush this under the rug. This has to be something that needs to be mentioned because as a dividend stock and as somebody that's investing in dividends, you want that dividend to grow over time. And, that's not close enough to wash it out. Realty Income, their 5-year growth rate is much better, more than double STAG Industrial. So as far as the growth and future potential of raising the dividend, we got to give that to Realty Income. So the next metric that I want to look at, if I just go back to the summary page of STAGs, is the FFO, the funds for operation. Now, guys, this is what I was talking about before when I was talking about payout ratios and things like that. Guys, with REITs, they are different than regular companies when it comes to earnings, okay? Real estate uses something called depreciation. So what happens with depreciation is it comes up on a revenue or a balance sheet as a huge expense. It is an enormous expense, but it doesn't cost the company anything. So what it does is it heavily skews the earnings. So we can't use things like payout ratio or even PE ratio. So what we do with REITs is we use something called the FFO or even the adjusted FFO. Guys, that's why you see such enormous payout ratios when it comes to REITs, right? Because they have their dividend, which is going out, and their dividend is really accounted for through its FFO. But when you negate a lot of their earnings because of depreciation, it shows that they were giving too much of their dividend away. When in fact, it was that difference of the depreciation which inflated that payout ratio. So instead of looking at the traditional payout ratio like we do with regular companies, where we look at the share price and then we look at the earnings per share, instead we're going to take the share price and we're going to divide it by the FFO, which is going to give us a much more realistic of how that dividend is stressing out earnings. So for REITs, instead of looking at earnings per share, let's look at FFO instead. That's how we're going to evaluate the true profitability of REITs. We see STAG right now, they have a forward FFO of 1.84, Realty Income 3.29. So funds from operation is much better when it comes to Realty Income. So once again, I'm going to have to give another check to Realty Income, where we look at, instead of the PE ratio, right now we have the price divided by the FFO, 17.77. So that would be like similar to a PE ratio of a company. Right now the PE ratio for the S&P 500 is around 20. So 17.77, if we were to look at STAG, they're at 15.29. Now for me, those are close enough to be a wash, but I know people get in the comments and be like 15.29, so much better. So we'll give the valuation, right? Is it overvalued, undervalued? Right now, STAG is at a better value as far as purchasing as opposed to Realty Income. Right now, Realty Income might be slightly overvalued when you compare it to STAG. I think other things worth noting, guys, market cap. If we just look at like the size, we have a market cap of $4.24 billion for STAG. That is much bigger, 5 times bigger Realty Income. But like I said, they've been around longer. They've had a longer time to, establish themselves and grow. So I'm not really going to hold that against them, but it's definitely worth noting if we're going to crown like the best, most consistent, most reliable right now. So if we look at the total revenues for both guys, once again, this is Realty Income in millions of dollars. This is 1.49, so it's really like $1.5 billion of revenue, where if you look at STAG, 406 million. So, I mean, if we look at everything side by side right here, you can be the judge. You can tell me if I've missed anything. I'm not going to say it, but I think you know which one I think is the king, which one is the #1 paying dividend stock right now. I'm not saying that one doesn't have the future potential to be great and even match up with the other one, but I'm talking about right now, even in the short term, one stands out to me. It's going to be the one that I continue to invest in until the other ones, especially the other ones I talked about earlier in the video, start to establish themselves and make themselves a prominent figure. Like I said, this isn't a video about good ones. I try to make a video about the best one. Hop down in the comments below, guys. Tell me what you think. And until I see you on the next one, stay positive, work really hard, always be kind to other people. I hope you have yourself an amazing day and an even better tomorrow.